I know you don't focus too much on the base metals or oil in particular, but it seems like we're seeing commodities markets dealing with a little bit more about the optimism of economies reopening. But then again, you have these U.S.-China trade tensions that seem to be simmering once again. How does that impact your world of soft commodities?
Well, certainly, yes. People still need to to eat, and even though they may drive less, the oil demand is starting to pick up, and obviously we've seen cutbacks by Saudi and Russia as well, which have helped. But it's just definitely looking like a kind of a U-shaped recovery, not a V-shaped recovery. We've seen a lot of restrictions also on shipping and the movement of goods and people, and so that takes time to recover. There's a bit of a backlog in the markets.
It's not just U.S. and China, but also China and Australia, where we've seen Beijing slap tariffs on Australian barley. How is that going to play out for the grain industry?
Yes, that was a surprising move there, and as you said, with these types of kind of trade wars going on and blame game with the COVID-19, that is obviously causing some disruptions. We've seen climate change and weather also impacting a lot of the rice and grains markets. There's been some strange weather going on, which also particularly heavy rains or not enough rains in the right place. So these types of tariffs are sort of boosting prices. We're seeing rice, for example, at all-time highs since about 2013-14. We've not seen these types of price rises. So that's going to impact, obviously, people who are already having a tough time, and now, general food prices are pushing up.
Yeah, that obviously has implications potentially for inflation as well, Tom. In terms of what we're seeing, because, of course, soybean purchases by China, U.S. soybean purchases, was something of a barometer as to how well the relationship or how badly the relationship was going. What are you seeing in terms of purchases in the soybean space at this point?
Yes, what was interesting is that obviously in February, March, we saw commodity prices coming down, and everyone initially sort of felt, oh, this is another 2008 kind of crash. But it was very different. This is the first time in commodity industry we've seen both a supply disruption in many markets as well as a demand disruption simultaneously. What was interesting, oil, cashew nuts collapsed very quickly. But a lot of the beans markets like soya actually held up pretty well. We only saw kind of a 5-6% slip during the initial impact of COVID-19. Prices have been recovering pretty well and still quite stable at the moment, I have to say. I think that's probably because of supply disruptions in other areas.
Okay, interesting. Storage is obviously a story that we've been discussing around the oil, the surplus of oil, and the lack of storage, particularly in the US. When it comes to soft commodities, what is the dynamic that you're seeing in terms of that demand for storage?
Demand for storage, well, at the moment, a lot of prices are very high. We've seen, obviously, shipping disruptions, which have caused supply disruptions, so stuff hasn't moved to the right places. Containers, to move goods have been in the wrong place as well, so that, there's many months of lag to get logistics in the right place. So that means the spot markets have been held higher quite well. So there's more of the demand for immediate supply as opposed to storing anything at the moment because of the backwardation in the markets. It's very much the
Tom,
oil
you've
that
made
has been
hundreds
stored.
Right. Okay, so mostly oil. You've made hundreds of transactions when it comes to commodities, from diesel, coal, red beans, the like. The fund, though, hasn't really been stuck with a boatload of cargo just yet. What do you think you're doing right at this point, and do you expect that to continue?
Well, our fund set up to specifically target and support SME firms and the smaller transactions, which are typically the agricultural markets and small energy deals. And so the biggest threat we have at the moment has been, because of the crisis, banks who are the traditional lenders and financiers for this sort of trade in key bulk raw commodities that keep economies moving, pulling out. So, there's a lot of nervousness in the market, in the credit markets, and naturally banks and traditional lenders are pulling out of this space. So we're really swamped at the moment in terms of demand from SME firms to help support, the smaller deals below $15 million per trade, which is probably the bulk of agri kind of deals, the food and the grain stuff.
And last question, Tom. Out of all the commodities that you cover, what stands out to you as being an outperformer? What's going to be more resilient to not just the COVID impact, but also the supply and demand dynamics that you just highlighted?
Yeah, it has to be the agri markets, I think, because there we've had the supply dynamics with the COVID-19 issues and continued restrictions of moving people and shipping around at ports, etc., which just slowed everything down. Plus also certain weather impacts as well in terms of droughts and also various issues in Africa with locusts, etc. So, there's going to be a bit of a strain on some of those key food crops, I guess. So those will continue to be strong.